7 out of 10 warning lights just turned red. One major bank lowered its S&P 500 target below where the market is trading right now. And the single metric Warren Buffett once called the best measure of market valuation is now near all-time highs, higher than the dot-com peak. So, what does the data actually say? And more importantly, what do you do with it? Think of the market like the dashboard in your car. One warning light comes on, you keep driving. You monitor it. But when 7 lights start glowing at the same time, you pull over. You check what's actually wrong before you make your next move. That's where we are right now. And the question isn't whether you should be scared. The question is, do you know how to read the dashboard? Bank of America runs what they call a bear market signpost system. 10 indicators built from decades of historical data designed to show when conditions are shifting from normal to dangerous. Right now, 7 of those 10 are flashing red, up from 5 in April and 4 in March. They're not all activating at once. They've been turning on one after another, accelerating. What are they tracking? In plain terms, consumer sentiment, investor complacency, credit stress, lending behavior, and this one matters most, valuation dispersion. That's the gap between the most expensive stocks and the cheapest. That gap is now among the widest since the dot-com era. When that spread is this extreme, it's historically a sign that speculation is running ahead of fundamentals. On overall market valuation, the bank also found that stocks are expensive across most of their valuation frameworks. The nuance worth noting: 3 of the 10 signals are still green. Not everything has flipped, and the bank acknowledged that today's large tech companies are genuinely profitable businesses, not the zero-revenue experiments from 2000. That distinction matters. But even those green signals, they said, are deteriorating. The green lights are turning yellow. Separate from market valuation, there's a second concern layering on top: the economy itself. One of the most followed economists in the US currently puts the probability of a recession in the next 12 months at 40%. The historical average in any given year is around 15%. That gap tells you something real. 3 pressures are driving that estimate. First, real disposable income, the money households have left after taxes and after prices, hasn't grown in the past year. Paychecks went up, prices ate the difference. People are running in place. Second, oil. Geopolitical pressure has already pushed oil up, and gas prices are climbing. If gas reaches $5, consumer spending could weaken enough to tip growth negative. Third, the Federal Reserve is constrained. Inflation is still too elevated for the Fed to cut aggressively. If they cut rates, demand picks up, prices rise further. They feel boxed in. Current market pricing puts the chance of a rate cut by year-end at near zero. Roughly 70% of the market is pricing in rates staying flat or moving higher. That's not a comfortable backdrop for growth. Now, 40% odds of recession also means a 60% chance there isn't one. I want to say that explicitly. This is a risk picture, not a certainty. The third signal is the one Buffett himself once called, quote, probably the best single measure of where valuations stand. It compares the total market capitalization of all publicly traded U.S. companies to the size of the U.S. economy, GDP. The logic is intuitive. If the economy doubles, you'd expect the companies inside it to roughly double too. Fair value is roughly 1-to-1. Right now, that ratio sits somewhere between 224% and 237%, near all-time highs in the modern data series. For context, above the dot-com peak, above 2008, and it's moved up significantly in just the past few months. Historically, where you enter the market on this indicator has a strong relationship to your forward returns. The higher the entry, the lower the expected return over the next decade. Here's the nuance, though. Even Buffett hasn't moved entirely to the sidelines. Berkshire has still made selective purchases, including a significant investment in Alphabet through a private placement. His own favorite indicator is near all-time highs. And yet he's still finding specific businesses he wants to own. That tells you something about how he's thinking about this. This is exactly the environment where the difference between owning a market and owning a business becomes critical. When I pull up Invyra's model on Alphabet, I'm not asking, is the market expensive? I'm asking, what is this specific business worth right now across multiple institutional valuation frameworks? What you're seeing here is Invyra running multiple valuation models simultaneously and returning a single weighted fair value. That number tells me whether the price I'm being asked to pay today is above or below what the business is actually worth. Not what the index is doing, not what sentiment says, what the business is worth. Then I look at the moat score. How defensible is this business if conditions get harder? What does the IQ score say about the timing? Is this the right moment, or is there reason to wait? All of that in one place in under a minute. This is the framework that lets you stay calm when 7 of 10 lights turn red. Because you're not reacting to the market, you're making a specific decision about a specific business at a specific price. That's a completely different process. Here's where I land on all of this. The signals are real. The data is real. An expensive market with slowing earnings growth and a constrained Fed is a harder environment than we've had for a while. That doesn't mean the market falls tomorrow. It doesn't mean it falls at all. But it does mean that if you're buying the overall index at current prices, the historical math on your forward returns is working against you. What it also means is this: the window between price and value is getting narrower in the broad market. But individual businesses can still be genuinely undervalued, even here. That's the Buffett insight. That's the whole point. He's not betting on the market. He's betting on a specific business at a price he believes makes sense. If conditions deteriorate, if we do get a correction, that's not a disaster for investors who know what things are worth. It's exactly the moment you've been preparing for. The businesses don't disappear. The prices get better. Calm and prepared beats surprised and scared every single time. If you want to do this kind of analysis yourself, run the valuation model, check the moat score, understand what a business is actually worth before the price moves, Invyra is in free for now. No credit card. Link in the description.